Smart money is exiting. Should you? There's a huge shift going on with professional investment, venture capital, and private equity, what we call the smart money. Must take note of. Back in the third quarter of 2024, there were just 43 VC-backed exits, a figure that surged to 359 in the third quarter of 2025. Clearly, the smart money is taking advantage of this robust M&A market to exit investments. Should you be doing the same? Here are 5 reasons why venture capital, smart money, are exiting their portfolio investments. The first is what we call AI dummies. One reason VCs are exiting their investments is due to some of their portfolio companies being AI dummies, meaning those with limited to no AI capabilities and no roadmap on developing these features. AI enables once-in-a-generation improvements in productivity and innovation. Companies that are falling behind the AI curve are being let go by professional funds. Are you at risk of your company falling behind the curve in AI? If so, you might want to consider selling before you lose your competitive edge. The second major reason is the IPO market. It's still dead. Professional investors traditionally exit through IPOs. A strategy is no longer possible as we're way off our 2021 peaks. Instead of going public, investment funds are turning to private markets, their only option to generate liquidity and monetize portions of their portfolio. For you, if you thought your exit strategy involved going public through an IPO, think again. M&A may be a better alternative in this market. Third major reason is the popularity of bolt-ons. Bolt-on deals, that is, platform companies funded by private equity consolidating a market by buying additional companies, represents over 2/3 of the tech M&A market. They remain very popular. Indeed, across all industries, bolt-on deal values are up 18% and deal volume up 39% in the second quarter of 2025 compared to the same period last year. That's a huge jump. Not surprisingly, professional investors are taking advantage of this robust market for potential bolt-on deals in their portfolio. Shouldn't you? By the way, there's an estimated 75% of the companies in this broadcast would be considered bolt-ons. Next major reason is divestments. Divestments represent a sizable portion of exits as PE funds opt to sell off portions of their portfolio instead of the entire asset all at once. For example, the sale of ABB Group's robotics group to SoftBank. That's a divestment, announced in October. In the second quarter of 2025, divestments represent 10.1% of deals, a level 13% higher than the 5-year average. Divestments are a clear way to take money off the table. Do you have assets that can be sold for liquidity? Lastly, there's startup exits. The rise in venture-backed deal-making has been highly beneficial for savvy startups. From the third quarter of 2024 to the third quarter of 2025, startups as a percentage of sellers rose from 28 to 38%. As these companies reach a sellable position, they opt to take cash off the table. This is especially true of AI-based companies that properly caught the wave. So how about you? Have you reached a level where it's time to calibrate the M&A market? In conclusion, these 5 trends demonstrate why the smart money are taking advantage of the strong M&A market to aggressively sell off assets. There's a record number of buyers and over $6 trillion in dry powder driving record valuations. There's never been a better time to sell.